I'm excited to have you back. I just decided to romp a little bit there with some House of Pain because you had so much fun with that garbage trade of yours. And then the pain came, and then the new Delta COVID narrative, whatever. But let's maybe first of all, welcome, and secondly, maybe let's just start with that. What is this latest Delta narrative?
First, Keith, thank you for having me on. Number two, your hair looks fantastic. Okay. And troglodytes unite. So we're gonna have to pull out.
And by the way, if you don't mind me saying, look at that jacket for an Irish guy is nice. I like it. That's I might. Can you give me? Can you borrow? Can I borrow that a little bit?
I raided Wink Martindale's wardrobe from his game show days. I have them all. Everything. Purple, you name it. I got it. What an amazing time. This has just been... This is what I love about this business, is that even though I do it for 20 years, do it successfully, you still never get everything right. And the goal is to be wrong enough, yet right enough to still make money. And that has been the case, but it hasn't been without some scraps. So we could just dive right in to the Delta variant and what's happening right now. The Delta variant is not actually really a big deal. It's not that much more transmissible, maybe not at all. And it's not really more dangerous, maybe not at all. I mean, think of these variants as akin to influenza. Every single 6 months, there is a different strain of influenza virus attacking one hemisphere or the other. And it changes almost every single year. And it's not because one is more virulent or transmissible or more dangerous. It's just chance. And that's how viruses frequently will work. It is just chance. And that's what we're working with right here with the Delta variant and Lambda, and there'll be Zeta and all the other ones. There's going to be, right now, floating around, I am certain there are billions, literally billions of variants. And just through probability and odds, just like with influenza, one will gain hold in a population, spread, and then fizzle out, exactly like influenza. And so that's what we're really looking at. However, it plays really well on TV. You may have seen yesterday, front page of the FT talked about Israel was spiraling out of control, Delta COVID.
Wow.
721 patients today. Spiraling out of control. Yeah.
Wow.
That's so they're literally out of news to print and they just can't stop. So a few things have happened though to change the tenor. Late last week. Number one, my model's on the UK, which is sort of the barometer for how Delta is going to go. UK is peaking right now. I tweeted it last week that it's going to peak within the next 7 days. It looks like it is peaking right now. And that also correlates with the soccer tournaments that went on over there. So you have a whole bunch of Scots all drunk, and I know this because I'm Scottish. So you got all these Scots that are pasted in a pub. Half of them are vaccinated. Half of them don't know where their right hand is. And that's how you're spreading it around. And so now that the soccer tournament is over, well, now we can get back to business. So I expect the UK to peak right now.
And you mean the rate of change of case count, or what are you talking about?
Rate of change of case count, yeah. So new cases will drop. It was about 35,000 or so today, and it's been about 33 to 35,000 for the past few days. And this is probably where it peaks, because I'm looking at saturation in counties, and they usually get, it's hard to tell right now because so many are vaccinated. Beforehand, before vaccinations, I could predict with a very high probability where the saturation would hit in any given county and then when it would taper and roll. Here, I don't really know what that saturation will be because so many are vaccinated. So I think it rolls. So the other thing that happened that's a really big deal last week is that Pfizer is moving forward with a Delta variant vaccine. That very likely will get through the FDA and be approved in September, and on very little data, but that's okay. You don't really need a lot. And then lastly, China easing. And so you put these sort of three things together, and now you have a vehicle or a direction, a map to get you to the other side of the Delta variant. You have China beginning what is probably a very big easing cycle, and then you also have the UK peaking. So I think that will be the tell. And what I'd be looking for, I'd love to say that it's going to be the yield curve that is going to direct us on what is going to happen. But as you know, the yield curve, I want to say that what it's done over the past 3 to 4 months is inexplicable, but it is not inexplicable. There are very, very good reasons as to why that's happening. And I missed why. I missed why the yield curve moved the way it did.
Well, that
so shame on me.
Yeah, I want to, well, so did the Fed, and the Fed didn't realize their impact, I guess. I mean, they should always realize their impact. As you like to say, the Fed has to do with a lot of things. But how do you, before we get to that yield curve part, which is obviously important, how do you think about peaking versus reopening? And, you know, I've been long Europe for a while. I'm not long everything in Europe, but Germany specifically. Like, how do you think of, you know, reopening to the, you know, tailwind that will be in European countries, or the UK for that matter, in terms of, is it positive or negative?
Oh, tremendous question. The reopening, in my view, is just getting started. And there are many, many, many reasons for it. If you think of global aggregate demand, the US, good, Europe, not good, rest of the world, bad. And so you really have a lot of slack out there everywhere, especially in Southeast Asia. And it's going to get worse a little bit before it gets better. Mm-hmm. And so once that demand comes on, I mean, we're looking at meaningful demand. Mm-hmm. And the US is in a slightly different situation than the other countries because of what the Fed did to M2. And for your listeners that don't know, M2 is a way to measure how much actual money is stuffed into the system. Mm-hmm. And you can see it predominantly on the balance sheets of banks in the form of deposits, if you will. And it is at a level that is absolutely uncomparable to anything else we've never seen anything like it. I'm at a loss for words to explain it. It is off the charts. Yeah,
we had, I don't know if you saw it, but I had a good, real conversation with Steve Hanke about that, Professor Hanke, who's obviously a big money supply growth guy and velocity of money guy. And I was actually surprised, in terms of like what his model was suggesting inflation would be, because quite literally he's the only person that has higher inflation numbers for longer than we do. So that's part of it too. I wonder if you agree with that kind of way of looking at the world. As you know, just increasing the money supply doesn't increase the velocity. But his whole point is that the velocity of money has been much more instructive here than most things. And I think what you just said, it's on top of the biggest pile ever.
It is absolutely unbelievable. And I'll tell your listeners, just to give them a gauge about that in a minute or so, because it really plays into what I personally in my trading got wrong. And so did Druckenmiller, and so did Tudor, and so did a lot of the really, really smart players who are short bonds on the 10-year and probably beyond. And they got absolutely smoked. And I couldn't understand for a moment why the yield curve moved the way that it did. But we have to take a step back, because we're not upset about the yield curve. We're upset about how stocks moved. And so we have to remember that you and me and your listeners and all the hedge funds running active management out there, we are dinosaurs compared to smart beta and passive flows. Passive flows dominate. It's now over 55% of the allocation. So those flows get allocated, though, based on the dumbest algorithm you could possibly imagine. It is based almost entirely upon the shape of the yield curve.
Yep.
And February, March, we had a steep yield curve. People thought it would go steeper. So they thought industrial companies, cyclical companies, consumer companies, airlines were going to smoke it and put up giant numbers. And they are. But a funny thing happened on the way to the Treasury. And this is the point that everybody missed, including myself. And it took me up until about 4 weeks ago to figure out what the F happened. And it's tax receipts. In 2Q, the Treasury brought in, and I believe it's about 20% higher taxes than in 2019, year on year versus 19. It was an ungodly tax number that they brought in. And what that meant is that the Treasury didn't have to issue as many treasuries as they anticipated, or at least what the street anticipated. However, that's the seller. The seller is the Treasury issuing. The buyer, you and me, pension funds, well, it's not you and me, it's pension funds. I mean, you have to ask yourself, who the heck is buying treasuries 10-year in Japan? Who's buying it in Germany? We know it's only the central banks, including here. And right now it's to the tune of $340 billion plus a month, which is also off the charts. And we talked about this last time I was on the call when everyone thought we'd have a steepening yield curve and it was going to happen violently. And I cautioned everybody that because of the carry trade and because of the Fed out there with the hammer, just hammering down yields constantly, it will be a gradual lift. And I still believe it's going to be a gradual lift on the long end of the yield curve. I think what made this flattening of the yield curve here was the short positioning in the bonds, plus the tax receipts that came in, so they didn't have to issue as many treasuries. So therefore, you just have the Fed buying blindly because they don't know. They don't care what the price is. You ever see the Fed say, oh, that's not a good price. We're not going to buy today. Nonsense. They're buying every day. They don't even know what the price is. They have a button. They press it. Monkey button, monkey button. This is what they do.
Yeah, I missed that too. I mean, as you know, I'm a rate of change data guy and I'm not so much a flow guy on stuff like that. I mean, what's interesting too is that the Fed's balance sheet was still expanding. So if you're looking at that flow, you're looking at the wrong flow. And when it finally broke down, like what the schedule of buying versus selling looked like monthly, I was shocked. So, shame on me, I guess, for not seeing that. But on the other side of it, now we have inflation numbers that are a lot higher than even I had, which we've had, like I said, the highest numbers the whole while since November. And
yes.
and what typically, just trying to get to the money making point, what typically steepens the yield curve is the confluence of both the labor market accelerating at the same time that inflation is. So, from here, one, do you agree with that? And two, do you think that those two components will continue to do what? I mean, labor really hasn't accelerated the way that it can or ultimately could.
I used to agree with that. How about that? And in this job, in this business, you have to go back and do forensics. And all of these things on the screen are all vectors. They always have direction, momentum, volume, price. And we're looking at a treasury environment that does not follow the economic data that is put out, meaning the earnings. And I made a mistake, and I make this mistake rarely, but I swear it happens every 4 years, where I don't care what the yield curve is. The earnings of my companies that I have, I did such great work on it that I'm going to be right no matter what. You're right? And whenever I have a mess, and don't get me wrong, I'm doing very well for the year, but not unbelievably well for the year, which is where I was in, let's say, March, April. And what I got wrong was the kinetics, or you would say the flow, but the kinetics of what has to happen to the treasuries. Yep. And then what I already knew, though, was that the yield curve, the shape of it allocates where new money goes into, all that passive money. And so with a flattening of the yield curve, because of all these shorts blowing up and the Fed coming in and stamping it down, of course, they don't actually know what they're doing. They don't realize how this is going to affect stocks. And I don't think they really care in this regard. They just know that they'll go up, and they don't care which ones go up in it. It's nonsense to them. So what happened is that the yield curve flattened, the new money comes in and says, oh, we're one step away from a recession.
Yep.
And with that, it goes into tech.
Yep.
Incrementally, it comes out of consumer, out of cyclicals, out of fins. And those don't work, and only tech works, because according to that yield curve, we're one step away from a recession, which is absolutely not the case. And I agree with you wholeheartedly on the rental rate equivalent going up through the roof over the next 18 months, and wages. And we have not seen wages go up materially yet, but we are going to, as this unemployment benefit rolls off between now and September, October, depends on the state. Based on just my own survey, talking to people, and heck, I have some construction teams that work for me through a LLC, and my wages are over 20% higher year on year. And I don't mean year on year. Like we didn't take down their wages a year ago. So they are, let's say they're up 20% from 2019. And so every household on the lower end, which is the majority, by the way, of the public, so lower end, that's where the masses are. They are going to be looking at 10 to 20% increased wages. They're also going to be looking at a $3,000 to $6,000 increase in the child tax credit. And we'll see if this actually becomes a durable child tax credit. I believe it will, because this is Biden's way to push in a universal basic income through the child tax credit. So these families are basically looking at a meaningful step up in household income. And that is going to drive a lot. And then, go on, Keith, please.
Just so that everybody has a data series to put in front of the words that you just put in front of us. Slide 63, guys, showing shelter's impact. Shelter is 33% of the CPI weight. And for example, today that number went, Mike, as you know, from 2.2 to 2.6. So to get to, as I keep saying, to get to 3.5 is a layup. I mean, that's just where it was before we've had the second coming of a housing bubble and everything that you just walked through from a labor inflation perspective, the whole kit and caboodle at this point. So it's a pretty easy one to get right, but I think from a calculus perspective, never mind calculus, this is just adding and subtracting the components of the CPI itself in terms of marginal impact. But I mean, I think this is something that the street's going to continue to have wrong, and the Fed's going to have wrong, and a lag to them having it wrong. Another slide is slide 64, where you have this OER, or owner's equivalent rent, playing catch up. Now you do have, and this is what I want to ask you about, you've personally invested in rent. I mean, if you don't mind, you want to kind of go through that, and if you don't want to touch on it because it's like a personal investment, that's fine.
Late last year, I worked with a developer, a very bright fella, wonderful guy, and actually several developers, but one in particular that I can work with personally, not in a big group, so it's just us two.
Awesome.
And last year, I looked at this and I saw the child tax credit and then what we'd have with this wage growth. How do I trade it? And I really didn't have a way to trade it in any stocks that I did. So we're in the process right now of picking up hopefully more than 30 rental properties in New Jersey. And it's an unbelievable situation where if you have a family of 4 and you're in the lower middle class, you're going back to work. One of you have been out of work at some point in the past year. You've gotten a bigger child tax credit. That's going to stick and stay. You're also looking at, as a family, probably 10 to 20% increased wage growth. But the funny thing is, you can't buy a house because one of you haven't had a job for a year. And usually that's a requirement when you get a mortgage, you've had a job for a year. So they rent. Rents right now nationally are up 11% year on year. That is right now, I saw the data last week. And I believe it's going to go much higher because, for a number of reasons. One, because of the eviction situation where you have so many deadbeat folks in properties and the landlords are over a barrel, can't get rid of them. And the people don't have to pay, so they don't. So what's going to happen as this eviction situation clears between now and September, all of these renters are going to go find a new rental. And so we're going to have a very big merry-go-round of folks moving. In addition, all the people who maybe wanted to buy a home can't buy a home because one of them's been out of work for a year or 8 months or what have you. But they are going back to work still. You're going to have to wait till next spring. So we have this window where wages are going up. There's no new home building on the low end because of the cost of goods. The builders haven't been willing to execute on more lower end properties, if you will. And I just mean lower end as in things that are not above $400,000. I'm talking about things that are below $400,000 a unit. And so that's what we did. Went out there and are scooping and scooping and scooping in a smart way. And that's, I will say this, that the yield on this stuff that we're looking at right off the bat is about 15% before improvements, which is an incredible yield for rental properties, which is just stunning. And I think we're going to have 8% pricing power in the next year on top of that.
I mean, a lot of this is going to be subsidized too, as you know. So I mean, there's no irony that we had a major asset manager come back into this market. I think only maybe 2 or 3 weeks ago. It was right before I took a little bit of a break. But you have like one of the stocks we like, AMH, American Homes for Rent, is literally doesn't go down. There are a lot of institutional buyers that are racing against the troglodyte in that regard as well. So it's because everybody knows, right? It's not like Larry Fink doesn't know what the government's going to do to subsidize low-end housing or first-time homebuyer tax credits on first-time homes for students or millennials that are entering their first, the 30 and 31, 32-year-olds are entering that household formation, years or trying to move away from their parents' homes. There's so many demographic and regulatory reasons to be there. But the institutional bit is certainly alive and well.
Yes. In addition to landlords who, you say you own 50 properties or something, and you want to lever up to take advantage of this, in many cases you can't because you have so many deadbeat tenants sitting there that the finances of your company look like crap, even though the assets are incredibly valuable. So you can't lever up against them and buy out more. So you basically have a lot of the established mom and pops, not like a Blackstone, that really can't participate. And so it's a really incredible window. I think it's going to last for about 18 months. And a very interesting thing is going to happen. And I consulted with my very good friend, Bill Pulte of Pulte Homes, about this and how it's going to play out. And he says, I agree that with this wage increase that families are going to have, all these lower end families are going to qualify for an additional $100,000 worth of credit to buy a house. In about a 1 year to 18 months. So all these houses that are 300, 350, they're going to go for 450 18 months from now. And I'm pretty sure that the Fed is not going to allow the yield curve to run away. In addition, BOJ, doesn't have a prayer, right? So that yield curve's not running away, and Europe's not running away. So I think we're still going to have money printing or incremental money printing somewhere in the world to a high degree to help foster that carry trade, which keeps the 10-year down. And so I think the move up in the 10-year is going to be gradual, and it is going to be way below the pain versus the increased wages that we'll see on the, let's say, the bottom 40% of America. And that's where I really expect the wage growth. It's actually, I want to say the bottom of 40% by income. That actually number represents more like 60% of American population.
All you need for the 10-year yield to trade in, first of all, a tighter range with less volatility. It certainly had plenty, the entire MOVE index has had plenty of that. is all you need is quad 3 conditions. You need a little bit of stagflation as opposed to straight up and to the right. And that, of course, would make bond yields, they could trade choppy. They could trade with a slightly upward bias, slightly downward bias. It's just not the going from 70 basis points at 175 in pretty much a New York minute, where a lot of us took advantage of that move. But again, it's like, why do we have to like light our hair or jackets on fire on that? I mean, it's just deal with it. All it really does to the market is it gives it a broader bid to tech, as you pointed out earlier, does it not?
Well, so far as what the market is going to do, I actually think that all the stocks are going to go up. And I'm looking at my stocks right now, my whole universe, as I look over to my right. I think it's very much like we talked about in the middle of last year, and probably at every point since March of 2020, is that the stocks have a lot higher to go, and it doesn't stop. I'll have to reevaluate when we get to the point where the Fed is not printing.
Right.
And then I have to reevaluate. But I don't know how stocks go down. Mm-hmm. And that's like famous last words, right? Okay, that's what we're having 20% correction tomorrow. Get your puts out. I'm saying, because there's just so much money out there sloshing. And the additional money that people underestimate and forget is the M2. And the M2 is sitting on the bank's balance sheets. And the degree of how much is astonishing. Banks are sitting on 3 years worth of excess deposits to lend. So it's a hot potato because they have to pay for this money in deposit form, and they want to get it out the door. And how do you get it out the door? Well, when people go back to work now, higher wages and easier lending, because it is a hot potato at the banks. We're going to see an incredible amount of real estate lending, business lending, 3 guys in a garage lending. I think we're going to see an amazing amount of new business formation, and the multiplier that's attached to this is really significant, because there is CapEx, there's that sweat equity, and that builds a lot of value for the economy in the form of productivity and wages. So I think it's going to be multi-year. The banks, it's going to take years for them to get rid of it. And like my good friend Pulte said, this is going to end like all great cycles in a massive housing bubble. And that's where, and he's a little biased. Okay, he builds homes, So, but that's how he thinks it's going to end, and that's where it's going to go.
Yeah,
I don't find a way out either on how it's going to go, except for that.
He's a realist. He's no permabull, that guy. And he's a great guy, by the way. He contributes greatly to this great American society. God bless Bill Pulte. But what I was going to go to is actually back to what you said. I had one conversation, and it was actually yesterday, and the gentleman is formerly of one of the motherships. He was one of the survivors, much like you. And he's one guy who's now at a long-short fund where he could swing it around. In a different state, and he's the one person that dared say, or had a line of questioning for that matter, which implies what they're really saying, what you just said to me. Like everybody else that, well, first of all, everything in terms of positioning in the market, net short across the board until recently in SPYs, NASDAQ, Russell, everybody's going to be a loser. Everybody's talking about, like Mike from Morgan Stanley or whatever, rolling corrections. I mean, rolling corrections, we're rolling up to new all-time highs every day, buddy. And people are legitimately all trying to call the top, Mike. Very few people will say, and again, it's not like I'm talking to a bunch of rookies out there. I mean, most people are scared to death about quad 4 or the beginning of the end.
Well, a funny thing happened to my portfolio on the way to the theater.
Again. Hey, did you know my brother played Hero, by the way, in that great play? I
did not know that.
He was on the B squad at Hilton Head, but he played Hero. He's my brother was the artsier of the two of us, and I got a lot. I'm a big fan of those one-liners.
So 75% of my hedge funds that I'm invested in are flat to down on the year.
Yeah, I hear that a lot.
And I actually expected it.
you're actually there's some that are down a lot more than that, to be clear.
Oh yeah. No, I look, the people that I invest with are people that I've known for 15 years.
Right.
And so I know exactly how they think, and I invest with some brilliant people. Jack Woodruff at Candlestick, and Kishan Mehta at Averill. And those are just two of the guys that I've worked very close with over time. And they are, they're brilliant, and they're going to do unbelievably well over time. And they already have done unbelievably well. But this year, struggle, down low single digits, and or they're about flat. But the point is, we have really, really smart guys who just got trounced. And the reason why they got trounced was the Fed manipulating the yield curve, which forced smart beta to shift its allocation. And that's it. It's that dumb.
Well, I think
why the yield curve move? It was treasuries, and they didn't have to come to market as much. But I will submit this. Right now, as of this quarter, it's looking down 7% versus 2019 on tax receipts. And so we may see the Treasury have to come back to market issuing. And I haven't done enough work on that yet, but that would be very yield curve positive. Not saying the yield curve is going to move up much, though. Okay, just remember, the Fed's out there with a giant goddamn hammer, and so is Kuroda, and so is Lagarde, and actually in secret, so is China.
And so is corporate America. These balance sheets, the cash isn't just going to sit there. I mean, the buybacks, we've shown this plenty of times, are reaccelerating once they get out of their dark period. But I want just to whack the beehive a little bit more here on the dark side of our lives, the hedge fund business. Not the dark side. We tried to put some transparency on it, right? Troglodyte comes out of the hole, puts an eye on it, Hedgeye. It's transparent.
Looking for money.
You get this guy like with the beautiful green jacket. We're the nice guys. We are the light, so to speak. But back on this. I'll cede your point on this most recent yield curve move having tremendous impact on a lot of people, and particularly in their cyclical positioning. But this has been a monthly thing, Mike. This year, and I wanted to get specific commentary on the liquidity and leverage problem. Lack of liquidity and leverage in the system are trying to run neutral. Every month it's been for a different reason, Mike. This most recent month, you've articulated why. But the first month it was high short interest stocks. The second month it was actually the interest rate surprise to the upside and a steepening yield curve. Every single month it's been a different reason on a 1 to 3 to 5 day window basis to puke at the lows and or to chase the highs.
Well, it's like I said earlier on this program, these guys are super micro. They know the earnings for all the companies,
right?
And so they have their bets accordingly. And all of a sudden, the 10-year does whatever. They're not even looking at the 10-year. I mean, it's out of one eye in the corner all the way over there next to the cat. All right, that's it. They're focused on the earnings. And, hey, Warren Buffett said, you follow the earnings. Short term, it's a voting machine. Long term, blah, blah, blah. And they got smoked like you can't believe. I mean, really smoked. And yours truly did not do well over that 3-month window either. And once I figured it out about 5 or 6 weeks ago, I had to adjust very sharply because I was thinking, and it was Mike Green that helped me out on this too, figuring out on the flows and why it's happening and how it's moving. Right. And I think Mike Green.
Yep, we've had him on Real Conversations. He actually did his first one recently. He's great. But maybe a question on that too. So you're agreeing with me on how difficult it is to run neutral with a lot of leverage and a lack of liquidity, right? I think you're agreeing with me, right? You agreeing with me on that?
Oh, yeah. It is the best, worst job you could ever have.
Right, tough. It's the toughest job. Think of it as being in the major leagues and all of a sudden the strike zone just gets reduced by 60%. And you still have to hit for the same average, which is impossible. It's a tough game. It's a real tough game, and I know that sometimes, once in a while, I'll agitate people with commentary about that. But the fact of the matter is that talking about the game as the game is evolving and being played is one of the most important things right now. When you go through a period, like you said, it took 5 or 6 weeks. This is very typical of what happens to me as well. I'll go from, sounding like I can't get anything wrong to being violently wrong, and then all of a sudden you got to figure it out. How can like in some frame of time here, can you explain those stages of grief to getting to the right side of the trade?
Oh, God, can I ever? Let me consult my diary.
Well, you've only
This
seen
is why I have this wand, by the way. My wife gave this to me the first week I started a hedge fund. And when I got my first book, and I've had it with me the whole time, and I just shake it. So all the guys at my desk, they know me. They're like, Mike with the wand, making it work, making it work. Well, we do that. We all have our little treats and toys and things we have to, dolls. Well, I don't know, not everybody. So it is, right now, everyone's grossed down. Grossed down because they got their faces ripped off. It's been incredibly painful. I mean, wildly painful. And I only see these sort of types of pain when the Fed is going hog wild, typically, because the moves don't make a lot of sense and they're incredibly persistent. And so I've seen a lot of smart guys, very smart guys, taking down their books 70%. A lot. And honestly, that was the right thing to do. But the setup from here, I think is much different. I think that we will find out that the Delta variant isn't as scary as everyone thinks. A lot is priced in right now on that Delta variant.
Yeah,
and if it isn't as bad,
and a lot is priced in terms of negative. Like
negative. Negative is priced in, and I think they'll follow the UK, and that peaks within the next week. And then we'll say, oh, the U.S. probably isn't going to be that bad. Oh, by the way, Israel has 700 patients a day, and that's probably around the peak for them too. So it's just nonsense. It's such a tiny blip, it doesn't matter, but it makes headlines. And then what's going to happen to all that levered money in hedge funds? They got to deploy it in a hurry because they have to make money back. They have to make money back. And so what are they going to do with it? And I think, and this is where I can talk about some of the things that I'm thinking about and what I'm doing and what I've been buying. And if you would like me to lead into that, I can for a few minutes.
Yeah, go for it.
Okay. So there are a number of names in energy and materials, namely steel, that are going to literally earn their market cap in the next 18 months. And it's going to be much more durable than people think. As the world gets turned on, energy is going to become a huge problem. And so what I've been buying is Cleveland Cliffs for steel, Arch for coal. This is ARCH ticker. And AMR, also another steel input player. And AMR is the ticker, of course. And I think that these three companies, and I'm not going to talk about them in depth because it's not my big idea. I have another big idea. But these guys are actually going to do extremely well. I normally don't do these value plays. If you look over my shoulder right here, too cheap to ignore, all right? These are my 5 investing mantras. New product story, roll up and mix shift, geographic expansion, management turnaround, and too cheap to ignore. And I hate too cheap to ignore. But these names are too cheap to ignore. These are the 5 only investment 5 theses that I have. And it's taken me 20 years to come up with that stupid list. So there it is, take a picture.
That is awesome. By the way, you have to look at that every time you look away from the screen. You can't forget that because you wrote
What's that?
Right? Like your screen's on the other side of the room, isn't it?
Well, look, you don't think I have eyes in the back of my head? What are you doing? I worked at a hedge fund.
That's awesome.
It's the same on the back.
That's awesome.
So those names are steel and coal and some other energy names are going to do very, very well. They're incredibly cheap and they're going to earn. And I hate cheap. It's just that, remember what happened to energy in 2008? Remember? Do you remember that?
Yeah.
That squeeze in energy and oil went to $140 a barrel in the middle of the worst recession you could possibly imagine. I see a situation like that. No, not so much the recession, but where everyone ignores it, can't be there, and then all of a sudden these things are going to explode. And they already are up quite a bit. But I'm looking at these things and I'm like, they're still going to earn over the market cap in the next 18 months. This is incredible. I haven't seen this crap for years. All right, so I got to talk about how much time we have left, Keith.
Enough time to talk about, I'm sure, the tickers that people are going to ask me about first. They're
going to ask about PCT. They're going to ask about Recur.
Yeah.
Because that's what I pitched last time. All right, that's it. Get my PCT hat on, my hard hat.
That's it.
All right. So I pitched Pure Cycle. Pure Cycle is so I went out to the investor day, and it was their first investor day. Everyone came to the plant, and I thought it would be me and like 15 other guys, because it's you fly into Cincinnati and then you take a 2.5-hour drive through Kentucky to get to their first plant. And so I thought nobody was going to be there. Wrong. There were over 160 investors who came out there in the middle of nowhere, and nobody could get a car rental either. So it was like people were just hitching rides, sitting on laps, everybody. I could not believe it. And what that meant was, and I got to meet a lot of people there, and I knew a lot of people there because they're in my business. And a lot of vanilla guys don't own it, and they're hoping to own it. They're hoping for a liquidity event that's probably not going to come, meaning a big share issuance or something like that. So what I expect for this company to happen over the next year, they're going to finish this plant. We saw their pilot plant working, pumping out, and the scale up to make this plastic recycling really viable. This is not complicated stuff. This is guys with hard hats. This isn't biotech. They already have the process. They're just making bigger machines. In fact, they're already made. They're just coming in to be delivered and put in a building, and they're just running as many lines as they want to get to their $100 million of EBITDA. The demand is endless, and for now, the supply of their materials is easy for the first 5 plants or so, and so they got some years to work on the supply issues. But over the next year, I believe, and this is probably sooner rather than later, they're going to announce a European partner that is going to do the build out for them over there. And Procter & Gamble is going to do the negotiation for the licensing. And Pure Cycle is going to receive a major royalty on it. Europe is already taxing plastic. And if you recall, this company recycles polypropylene. Go back to our previous conversation about it. And this is going to be the only player that can do it. Their margin now is much better than the margin for a petroleum company making polypropylene. They proved to us that they have pricing power because they changed their pricing already before they even started. Now it's going to be polypropylene, the price of polypropylene on the market, plus their input cost, plus a margin on top. So this is going to be a meaningfully over 50% EBITDA margin business. First plant will be done by the third quarter of next year, and we should know what yields look like, and they'll be live in the fourth quarter. They're going to be breaking ground on a second plant, and now we're talking about $200+ million of EBITDA. But what's going to happen after the European partnership, or before then, and I think it'll start this year, they're going to announce 3 more plants to break ground on. And by the time they're breaking ground on those 3 plants starting next year, throughout next year, they're going to be announcing another 5 plants. And so you start adding up these $100 to $150 million of EBITDA numbers, and it gets huge, really fast. And so what I wanted to bring to your listeners was a name that I got very interested in, did a lot of work on, and I think it is a 10 to 20 bagger. And it's potentially even more than that. It's about 2.5 billion market cap, and they're not going to build 10 plants or 20 plants or 30 plants. It's going to be more than 30 plants, and probably very similar throughout Europe. So it's a big idea, a really big idea. And I hope it goes down more so I can get more. I tripled up on the last move down on that Hindenburg research report. Right after I pitched you here, Hindenburg came out, if you recall.
Yeah, I recall.
And they crushed the stock. Well, Hindenburg just did an interview on CNBC. I don't think it was live, it was in text. And they had an interview talking about all their big short ideas. And they did not mention PCT, Pure Cycle, because they're wrong and they know it.
Well, Hindenburg's interesting, not that we need to go down a big rabbit hole on this, but it's a different kind of research, so to speak, than what you and I are used to. I mean, there's sensationalism, there's a lot of narrative, and there's positioning, obviously. There's self-interest in positioning ahead of the big report or the big reveal, which sites like Zero Edge and all these others really need. They really need in Hindenburg. They need people to be sensationalist about things. Any thoughts on that?
Well, their job is to short stocks, write sensationalist research, and then make money on the short. And that's what they did. you read the short piece. It was garbage. I mean, it was just a bunch of hearsay, if they, maybe who, hey, they're really building a bomb. All these plants are going to blow up. I mean, it's total nonsense. So, but they got the SPACs in a situation where they're all scared. They all had weak hands, and there was no sell side research at the time, and it wasn't in the benchmark. Now it's in the benchmark, and we have institutions that are doing the work on it, a lot of work on it, and ESG is not going to go away. And the pilot works. We already knew the pilot works, and we know what the costs are going in, and we know what the profits are coming out. This is actually one of the more easy models that I've seen in a really long time.
Yeah, so, I can like I sit on the research floor, as you know what our setup is here. It's like a trading floor, but it's just research. And they came out with something, I believe it was on Draftkings, and my analyst right away popped up and he was like, dude, this is like, we know a lot about Draftkings. We've modeled it plenty of times. We do all the work. And it's just different. Like, it's just a narrative. It's to get you to look over here instead of over there. It's interesting. I'm not trying to, if Hindenburg wants to take a shot at me, have at it. I'm just telling you that it's not what Mike and I do. And there's a difference. Maybe they're better than us. Maybe they're not. But there's another side of the story, and he just told it. So that
They have an angle. So I wanted to mention on Reeker Systems, because that blew up too. And so Reeker Systems had difficulty getting the Reeker 1 through the state legislatures. And I think the management has learned that it is very, very difficult to get, or at least harder than they thought, to get policy through the legislatures in an extremely timely manner, because everybody wants their piece of flesh. And that's what they learned largely. But so far as Reeker, I do believe that all their states are still on the table to get their Reeker 1 observation system through, which is a video camera that is going to monitor traffic and violations, usually around registration and insurance and things like that. And they'll get a piece of everything. And it'll probably roll out in most states. But the big news for them in the near term, as I understand it, is that their relationship with MasterCard is very likely to go national, and that MasterCard may, in the near term, be rolling out their Reeker 1 system to observe drive-thrus and monitor that. Because as you know, in a drive-thru, they always get your order wrong because they don't know which thing goes to what car. And so MasterCard started a pilot program with Reeker about 3 years ago. And it worked so well that I believe they're going to go national on it. And that alone would justify the market cap of Reeker, aside from everything else. So, look, I like to get on these things when I can, when they are beaten up and hated. And look, all the hedge funds already sold everything. They sold everything, PCT, all these names, because all their other trades blew up. And that's where I want to be. And that's where I've made a lot of my money trading as a hedge fund, is picking up their carcasses and carrying them off into the sunset. So I know it sounds horrible, but that's the way it works, right?
Carrying it around like that, carrying it in the sunset, that's fine.
Yep.
It's an amazing thing like this. First of all, you and I have had a relationship for a while, and to bring like our conversations to life, first of all, for me, it's been... I've plenty of gratitude for that. I think the audience absolutely does as well. But the audience still has to learn to not be the CNBC monkey audience. I hope everybody can appreciate that and take it constructively. Like, for Mike Taylor to get on here and for every question to be about a couple stock picks really is missing the point of Mike Taylor and my conversation. What we're trying to do is teach you good process, give you insight into how the game is actually played. The game, Mike, is not played the way that a lot of people think. There are a lot of people, and maybe it's generational. Tell me what you think about this. They're looking for picks, and they put like 10, 20%, half their capital into a bloody stock pick, and it's just what people do. And I'm a little taken aback by a lot of reactions like that, because that's not what I wanted them to take from you. What I wanted them to learn is something that they haven't been able to learn, which is how to play the game at the highest level from somebody who's done it successfully for a long period of time.
Well, you have to remember that I'm trying to deliver ideas to your audience that I do believe I'm invested in, and I believe that they are 5 to 20x baggers. Those are really hard to find, okay? But if I'm a long-term investor, and I assume a lot of your guys are, and they want names to put away, I think these are names to put away. But how I actually trade, the majority of my book, is things that are too complicated to explain in this setting. And that's the truth. Yeah. As you know, I'm a healthcare person. I'm a drug guy. I develop drugs. I'm a virologist. And, to go over statistics and really do a workover on this whiteboard, it's not something the average audience, and your audience is not average at all, but it's just difficult to follow. And so what I'm trying to deliver is things that is palpable, that they can understand, and actually valuable, really valuable.
And what I'd like them to learn is also portfolio construction I talk about it every bloody day on the Macro Show, but again, if somebody gives you a stock idea that you can put away, or Mike thinks you could put away, have it as a disciplined percentage of your capital at risk and understand the duration that you're going to own it. Please, if you can do that, then you're going to be in a much better place than chasing down stock picks and waiting on every bated breath on what's going to come out of Mike's mouth next on a certain ticker. That's not the way to do this. It's definitely not the way that the pros do it day to day. So I just wanted to make that point because I do get a little I get like anybody else. I kind of look at a queue like this and I'm like, there's so many questions you can ask Mike Taylor, but they're only asking about 3 tickers. That's not.
They're going to ask about this next one because I did have a really big idea, and what's really great about it is that it's already down. So unlike the others, when I had to pitch them, they were up, but these are things that I think are 5, 10x baggers. And so one that I've been buying in size is a very controversial post-SPAC total POS. And you guys will have to figure out what that means. It's code in the hedge fund business.
Yeah.
So, and the ticker is Frey. It's Freyer, and it is a battery cell maker, and it is shorted and hated, and people don't think it's a business or that they have a business, and I think they are very, very wrong. I believe they have no clients or no material clients as of yet to supply their battery cells. But it's a $800 million market cap. It's trading at 2 times cash, or maybe a little less than that, because it's gotten sauced here post-SPAC. But I believe in the very near term that they are going to be announcing a major supply deal with I believe it's going to be what you would call a conglomerate. There will be automakers involved. But they are going to be making enough supply by 2025, 26, to supply something like 700,000 cars. And they have a mechanism and a way to do it that is cheaper than the others. And that matters a lot. And if you take a look at how much of the battery cell business is going to be available to supply this market of EVs, which looks like is going to be meaningfully expanding, they don't have enough capacity to get to 2025. They desperately need other players coming in and expanding. And this is going to be one that does it. So I'm expecting an announcement from them on a meaningful partnership in the near term. And when that happens, all the shorts have to cover, because it goes from fake company to real company overnight. Well, and so I think your downside here is very, very limited. And as they fill up their capacity now over the year, and I think it's going to be pretty chunky as they fill it up, I think that this could be a 5x return.
What's interesting about that, or any idea for that matter, in terms of broken SPAC space or flaming POS space, as yes. I would never use those words, Mike.
I know.
I would never. But the fact of the matter is that this is fully loaded with the bearishness of it all. You have a lot of new issues that have de-SPAC'd, that have been shot for dead because it's a liquidity issue. When 5 hedge funds bark, 10 dogs bark, and the whole neighborhood barks, they all sell. And this has been a very unique period the last 3 months, where a lot of it, of what you said, is tied together. The performance problems, to the lack of liquidity, to the amount of leverage, to back to the performance problems, to the inability to hold a position. That's what gives you an opportunity to buy certain things. My research team and I are actually struggling with that quite a bit, in terms, not actually finding the ideas, but actually having the cojones to step up and make a call on one of those ideas. Because again, there's so many performance issues that you never know what incremental sell you're still having to try to get through.
Well, when I look at my hedge fund P&Ls, goddamn cleaning ladies with the vacuum cleaner. Jesus Christ. Hold on.
Well, come back.
You know, my wife goes, I go, Jill, I'm going to be on TV in a few minutes. Quiet down. She goes, oh, TV. What are you going to wear, the green jacket, honey? You're going to pull out the wand? All right. So where were we? Yes, hedge funds have been absolutely smoked. And they've had to dump all their SPACs already. And these aren't even SPACs, they're de-SPAC, they're in benchmarks, you know, and the CIOs and stuff of these smaller hedge funds are like, yeah, it doesn't matter. Oh, more Facebook, whatever. So this is where we are, where it's already happened. And the pain, incredible pain, has already been unleashed. And so when it turns pretty violently. And they have a lot of cash on the sidelines. They're not grossed up. So I'm really excited about it. And all it takes is a spark. You know, in the case of PCT, or a deal with MasterCard for Reeker, or a deal with a conglomerate to deliver battery supply for Freyr. You know, these stocks, and I don't do all these small cap stocks. These are just ideas I wanted to give to you that I think, and I'm not selling them, that I want to buy more of all of them. In fact, I did buy more of 2 of them just over the past 48 hours. And I want these things to, I think they're going to be 5 to 10x baggers and, you know, be there. I mean, I can always tell you, hey, I own Facebook. I own a lot of Facebook. I own a lot of Google. They're going to smoke numbers.
Yeah, great. I do
but,
too. I mean,
but that's not really right. What am I going to do? Now, I'll also tell you what I'm short in my bid book. I won't exactly tell you why. Well, I could tell you why. I'm size bearish in Wayfair, size bearish Sam Adams. Sam Adams, I've talked to a distributor, a friend of mine today, talked to a distributor for Sam Adams and their seltzer, because that's what's driving the stock. Sam Adams are trading at 31 times forward. I don't know what your shop view on Sam is, so I'm sorry if it differs. But the distributor said they can't take any more seltzer from anybody because they have 1,000 days of inventory. So 31 times forward, and the street, of course, models it like it's going to go up forever. And so they're just looking at a mess. Wayfair already started doing the phone calls to the street to take down numbers. So people started taking down their numbers for Wayfair. Wayfair is going to have margin problems.
Yeah, we
and also that's up 600% over the past year.
We're both
the COVID trade.
We're on the. When I said I own both on Facebook and Google, I mean our research team does. I'm not allowed to own it if they like it because we don't want to have that conflict of interest with our individual or institutional subscribers. But we're definitely on the same page with you on short Sam. And you had Coors.
Wow.
I think it was Coors. You know, depends on what country.
Coors Molson.
Yeah, they had news on the seltzer front the other day. You go to Vegas. I was just in Vegas, Mike, and you want to talk about like whether or not the reopening has toned down.
Hey, I went to PCT, Pure Cycle. I'm in the airport in Cincinnati. Okay, packed to the gills. Couldn't believe it. I thought people were like. You know, I had no idea what was going on. There were cows, there were chickens, there were people. It was crazy. It was wild.
Yeah, and what I was going to say is, like, if you go to where people are properly drinking, like Vegas, where I get up, you know, New York time, and I go downstairs to try to get coffee, and you see the real, you know, creepy crawlers. I mean, they're not drinking Budweiser's seltzer or Coors seltzer or Sam's. No. They're drinking what they know. They got White Claw here, White Claw there, a box of it over there. You know, they're whatever the moon stuff's called. It's an interesting one where you got quickly oversupplied in what I guess our analysts would call it a fad. You know, part of it.
Think of it more like this. I want to drink something without a lot of calories. I'm tired of Michelob Ultra, right?
Oh, it's terrible.
And I don't want anybody to see me drink it because it's kind of a trashy drink. And so what I'll do is order 10 cases and I'm keeping it in my cool basement. And so forget about the distributors with inventory. I bet you all these houses all over here in Hoboken got cases of White Claw in the basement.
I have cases of that in my house because my wife, post-COVID, on the reopening, started hosting her friends for parties, and she orders a bunch of that, and they don't drink like we do, so let's just start with that, so that the volume consumption isn't there. But I'm oversupplied in that too. It's what it is. What's great about you, Mike, is that you can bring ideas to life. You also bring the process to life, right? Like, you're telling people that you're not telling it because you're not that way, but you are playing at the highest level and still getting people to a place that they can understand what the hell you're saying, do something with it, and then actually have a little bit of fun with it, more than a little bit of fun with it. So we're kind of running out of time here, but I mean, I did enjoy that little bit with you barking at the vacuum cleaner. That was cool.
I apologize. That was a studio malfunction.
Well, I don't think CNBC. I don't think you'll ever go on, even if they invite you. But if you do go on, can you please do that? Just do that during the interview.
I might.
Take a third of the minute and a half that's allocated to you for them to repeat what you give them as prep notes, and do that for like.
And do that. So, no, I'll do it with the toilet seat and everything. I'm gonna love that.
Well, at least you'd be doing it in good spirit. Well, I think that's, in terms of time, we have to kind of wrap. We could go on and on and on. But again, thanks so much for...
You're a good troglodyte.
Yes. Pure, he's called me a troglodyte for years. I think I can call him that back in kind, although he looks prettier with that jacket on. Thanks for joining us.